The ultimate guide to investing in cryptocurrency. How to make money on blockchain, DeFi, Bitcoin, altcoins, NFTs, and the next big thing, the Metaverse. Written by Christie brothers, narrated by Russell Newton. When buying cryptocurrency for the first time, the smoothest approach as a newcomer is a centralized exchange. A crypto exchange is a platform where you can start buying cryptocurrencies such as Bitcoin, Solana, and Shiba Inu with a few clicks of your mouse. Cryptocurrency exchanges operate similarly to other trading platforms you may be acquainted with. They provide you profiles where you can generate various orders to buy, sell, and predict the cryptocurrency market. Some cryptocurrency exchanges provide sophisticated trading options like margin and futures trading, albeit these are less typical for customers in the United States. Others include features such as cryptocurrency staking or crypto lending, which enable you to earn money on your cryptocurrency holdings. The leading exchanges include educational resources to keep users up to speed on everything crypto. Various kinds of crypto exchanges. There are two types of crypto exchange: centralized and decentralized marketplaces. Each group has its own set of perks and downsides. Exchanges that are centralized. A single entity manages centralized cryptocurrency exchanges, CEX. Centralized exchanges make it simple to begin trading cryptocurrencies by enabling consumers to transfer their fiat money, such as dollars, straight into crypto. The overwhelming bulk of cryptocurrency trading occurs on controlled exchanges. Some Bitcoin fans are opposed to centralized exchanges since they contradict cryptocurrency's decentralized ethos. Worse, according to some cryptocurrency users, the corporation or organization may compel users to fulfill Know Your Customer (KYC) standards. To fight money laundering and fraud, they demand each user to reveal their identification, much as when applying for a bank account. Another issue with centralized exchanges is hacking. With the CEX, the site keeps the cryptocurrency exchanged on its site, at least for a time, while deals are processed, increasing the danger of hackers stealing cryptocurrencies. To combat this issue, centralized cryptocurrency exchanges have increased security in recent years. Among other things, they now keep the majority of client funds offline and purchase insurance coverage to protect cryptocurrency losses in the event of an exploit. If you like the ease of a centralized exchange, then you can limit your risk by moving cryptocurrency to a wallet off the exchange. Exchanges that are decentralized. Decentralized cryptocurrency exchanges, DEX, delegate responsibilities for arranging and confirming cryptocurrency deals. Anyone who wishes to participate in a DEX network may certify transactions, similar to how Bitcoin blockchains operate. This may serve to promote accountability and transparency, while also ensuring that an exchange may continue to operate regardless of the status of the firm that developed it. The problem is that decentralized exchanges are far less intuitive, not just in terms of the UI, but also crypto conversion. Users can't always deposit dollars and swap them out for cryptocurrency on decentralized exchanges, for example. This implies you must either already hold cryptocurrency or utilize a centralized exchange to get cryptocurrency for usage on a DEX. You'll also most likely be doing direct peer-to-peer deals. This implies it may take longer to locate someone interested in buying what you're selling, and if funds are low, you may have to make price concessions to purchase or sell a small cryptocurrency immediately. Cryptocurrency exchange fees. When you purchase and sell cryptocurrency, you must pay two sorts of fees: trading costs and withdrawal fees. Fees for trading. Trading costs may be levied as a fixed percentage of the total you purchase or sell, or An exchange may charge a variable proportion for orders that are makers versus those that are takers. Makers are transactions that bring volume to an exchange, i.e., they do not execute existing orders. Meanwhile, takers reduce volume from a marketplace by filling orders that are awaiting a deal. Maker costs are normally significantly lower than taker fees based on the exchange. However, this isn't always the case. While it is desirable to choose the exchange with the cheapest rates, focusing too much on the intricacies of maker and taker fees might be detrimental. This is due to the fact that you have no control over whether your order is handled as a maker or a taker. Instead, evaluate total costs as well as any reductions offered for trading a specific amount per month or keeping an exchange's native coin. It's worth noting that some cryptocurrency investing programs advertise to have no costs, but this isn't always the case. Rather than charging you a flat fee, they charge a spread, which is the gap between the rates at which they purchase and sell cryptocurrency. Spreads can and regularly do end up being significantly more expensive than a proportion trading fees. Fees for withdrawals. Many exchanges impose withdrawal fees for currencies held on their platform. This might be a problem if you choose to transfer your cryptocurrency to a safe third-party wallet or another exchange. Withdrawal costs are often different depending on the coin. If you want to withdraw your cryptocurrency from an exchange, pick a platform that enables a specific number of fee-free withdrawals, such as Gemini. Other charges? There are extra expenses involved with borrowing money if you participate in more complicating trading tactics, such as margin trading. Beginner-friendly exchanges, like as Coinbase and Gemini, provide rapid purchase features with higher costs. You can prevent them simply by learning how to purchase and sell using a trading platform provided by an exchange. If you pay with a payment card, you may be charged a fee by either the platform or your card company. That is why it's preferable to purchase cryptocurrency using dollars or bank transfers. How to select a cryptocurrency exchange. Aside from costs, consider security, trading volumes, instructional materials, and whether an exchange offers the cryptocurrencies you want to purchase when deciding on the best cryptocurrency exchanges for your requirements. Security. As cryptocurrency has increased in popularity and value, it's become a major target for hackers. Leading exchanges, like Binance and KuCoin, have been breached, resulting in losses of millions of crypto. While exchanges often compensate customers whose coins have been stolen, no one wants to be in that predicament in the first place. Spreading your cryptocurrency purchases over various exchanges might help you reduce your risk. Make it a practice to shift your crypto assets from an exchange's standard wallet within your own private wallet. These are storage alternatives that are not linked to the web, making them virtually hard to hack, though you must carefully note your password, or you may lose your cryptocurrency forever. Coins in the market. Consider the cryptocurrencies that are accessible on a certain exchange. You could be all right utilizing a cryptocurrency exchange that just trades a few currencies. If you're a crypto enthusiast, you might want exposure to the more than 700 accessible on Gate.io. Volume of trade. If no transactions are taking place, the supply of coins is insufficient. You should check to see whether there's enough trading activity in your desired coins to guarantee liquidity so you can quickly swap your coins and dollars. Low-volume marketplaces may cost you money in sales. Slippage occurs when there's little volume and you place an order. You may wind yourself purchasing at a premium cost or selling at a cheaper price than you would have preferred. If you're a seasoned cryptocurrency trader, be sure your favorite exchange has the trading kinds and margin you need, such as limit orders, which eliminate slippage by establishing a firm price. Remember that trading kinds, including the latter, are still emerging in the United States. Thus, the offers of various exchanges may vary over time. Resources for education. If you're new to cryptocurrencies, search for an easy-to-use platform with a wealth of instructional tools to help you navigate this complicated, fast-evolving industry. Accessibility. Finally, don't presume that a cryptocurrency exchange is accessible in your nation or state just because you can visit its website. Many federal and state governments are still thinking about how they want to approach cryptocurrencies legally and fiscally. Section 2. Crypto terminology. It's been 13 years since the unknown Satoshi Nakamoto published a white paper outlining how Bitcoin, BTC, the first cryptocurrency, would function. Many individuals find Bitcoin terminology to be an incomprehensible language. When describing a blockchain project, it's hard to avoid using technical words. Advanced coding languages are used to program these networks. If you're new to cryptocurrencies, studying some of the most prominent crypto slang terminology can help you get acquainted with the cryptocurrency environment before you invest. The basics of cryptocurrency, an explanation of 15 crypto terms. Blockchain. A cryptocurrency is a virtual ledger that allows transactions to be securely recorded. It is decentralized, which means there is no centralized authority in charge. Instead, before a new record can be registered, it must be confirmed by a computer connected to the network, known as a node. The word blockchain is derived from the network's structure, in which each item of data is referred to as a block. A chain is formed by new blocks placed in a progressive succession. Records stored on a network cannot be changed or deleted. To remedy any faults or errors committed in earlier transactions, a new agreement must be created. This ensures that they are not tampered with. Proof of work. Proof of work is the protocol that drives the Bitcoin network, POW. It's a consensus process that's used to verify new transactions before they're added to the blockchain. Although anybody may theoretically become a miner, in reality this process is energy intensive and requires a significant amount of processing power, specialized equipment, and storage space for high-speed servers. To verify a transaction, a miner or node comprised of many powerful computers must resolve an arbitrary mathematical challenge to create the hash, which will authenticate the new record. A hash is a one-of-a-kind integer that identifies a data collection. The distributed system is then updated appropriately, allowing anybody to verify the accuracy of newly updated information. Miners in a proof-of-work environment are paid by getting a certain amount of tokens for confirming transactions on the blockchain. Proof of stake. Another technique that can be used to run a blockchain is proof of stake, POS. Only miners who stake their cryptocurrencies are permitted to engage as validating nodes under a POS system in accordance with the number of tokens staked. POS nodes, like proof-of-work nodes, must verify all transactions by completing a mathematical challenge. They are rewarded for doing so. Miners, on the other hand, will only be able to verify a proportion of blocks that match the proportion of holdings staked. POS is championed by many because it is far more energy efficient than POW. Smart contracts. A smart contract is an application that's programmed to carry out a certain transaction depending on a set of predefined parameters. The blockchain executes these contracts automatically once the criteria that govern them are satisfied. Once a contract has been added on the blockchain, it cannot be changed. dApps. Applications that are decentralized are known as dApps. A decentralized application, dApp, is a software developed on top of the original blockchain. The distinction between a standard app and a DApp is that payments are verified utilizing the blockchain's infrastructure rather than an intermediary. Crypto wallets. A wallet is a program that allows crypto tokens to be securely kept. Because crypto tokens are basically bits of code, a wallet serves as a repository for these codes. A wallet prohibits other parties from gaining access to the passwords without the owner's permission. There are two kinds of wallets: cold, not connected to the internet, and hot, accessed through the internet. Hardware wallets are physical devices, similar to a hard disk. Mobile and desktop wallets can only be accessed with a smartphone or a personal computer. Tokens. A token is a coin that's used to compensate miners and nodes for validating transactions on the blockchain. These tokens are referred to as digital assets. They may be exchanged using either a centralized or decentralized exchange. Tokens are typically classed as utility tokens, which were established for a particular practical use. Payment tokens, or currency tokens, which were intended to be used as a form of payment, and tokens, security tokens, which are economically equivalent to shares, bonds, and derivatives. Although there are more categories used to categorize distinct tokens, according to FINMA, the Swiss Capital Markets Supervisory Authority, these are the most popular varieties. Gas. The computing work necessary to solve the unique problem given to mining one block or verify a single transaction is referred to as gas. The quantity of gas necessary to complete these activities will calculate the amount of gas costs that must be paid. Gas fees are the expenses associated with recording a single transaction on a specific blockchain and are often stated as a percentage of the token that runs the system or in fiat cash such as US dollars. The larger your gas limit, the quicker your operation will be validated and posted to the blockchain. Consensus. In a crypto dictionary, the term consensus refers to an arrangement amongst the many entities that operate to preserve the network's integrity. Most blockchains rely on a consensus method in which all people agree that every record contributed to the system has been properly verified. Although proof of work, POW, and proof of stake, POS, are the most well-known consensus mechanisms, there are as many as 11 different techniques of agreement, spanning from proof of elapsed time to proof of weight. Validator. A validator is a computer or person who verifies and confirms the validity of each and every record uploaded to the blockchain, regardless of whether it uses proof of work, proof of stake, or any other protocol. Validators are often referred to as miners in POW systems, such as Bitcoin. They're rewarded for their work by obtaining a certain number of tokens after mining a block or a series of blocks. Validators gain incentives in POS blockchains by introducing additional blocks and staking the network's currency. 51% attack. A 51% assault happens whenever one or more verifying nodes control more than half of the network's computer capacity, enabling them to control the transaction flow of the blockchain. Once this is accomplished, these nodes will be able to control which activities are validated while leaving others unrecorded. In a 51% assault, the controlling nodes may reverse any transactions added while they were in control. They may also double spend tokens, which is when a cryptocurrency is used twice. As a consequence, the network's integrity is jeopardized and the value of the token diminishes. Node. A blockchain node is a terminal that's linked to the blockchain. It's used to preserve the network's integrity by consistently validating new blocks that are added. An active node always has the most current edition of the blockchain. It regularly connects with the other nodes to keep them up to speed on any modifications to the chain. Hash. A hash function is a function that converts any input to an encrypted code. A hash is created in the blockchain world once the information from a transaction is confirmed and stored on the network. The length of a hash is fixed. This improves security since no one can read the information of a hash, but without the precise reference table that was used to create it. The miner's job is to encrypt any kind of record added to the blockchain by implementing a predefined hash structure with many parts. These sections, among other things, offer information about the preceding hash's timestamp, the hash created by the prior block, and the target hash. Based on the developer's desire, hash structures differ from one network to the next. Fungible and non-fungible. One of the most essential aspects of blockchains and the tokens that fuel them is fungibility. In economic terms, a fungible asset is one that may be exchanged for another asset or item of the same value. Fiat money is an instance of a substitutable asset, since it may be exchanged for commodities and services. A fungible token is one that may be swapped for yet another asset or token in the blockchain world. Non-fungible tokens, on the other hand, differ from fungible tokens in that they have no intrinsic value and cannot be exchanged for any other token. Satoshis. As the value of Bitcoin rises, many transactions are performed in decimal fractions of one Bitcoin rather than integer values. To promote the fungibility of Bitcoin tokens as an acceptable method of transaction, cryptocurrency developers have designated one Satoshi or one sat as the lowest quantity of Bitcoin that may be traded. Satoshi Nakamoto, the unidentified person who initially released the white paper that outlined how the Bitcoin network functioned, inspired the moniker assigned to this decimal expression. One Satoshi is equal to 100 millionth of a Bitcoin. Crypto jargon never lets up. The list of cryptocurrency jargon may go on indefinitely. Despite being a relatively new and fascinating asset class, Bitcoin has been steadily entering the mainstream, with worldwide acceptance continuing to grow. According to the Global Blockchain and Crypto Market 2021 research, blockchain technology is predicted to become a substantial contributor to global GDP, increasing it to $2 trillion by 2030. Section 3. Trading versus investing in cryptocurrency. When learning how to acquire and sell cryptocurrencies, you must distinguish between crypto trading and crypto investment. What is the distinction? Which is superior? And how can you use this distinction to create more successful trades? The two names are frequently used interchangeably. However, they're not the same. They are simply comparable in the sense that the final aim is the same, profit from your actions. They vary in that the outcomes of trading operations are often anticipated in the short to medium term. This might range from a few hours or days to a few days or weeks. The trader is in this for the long run when it comes to investing. We're talking about months, years, or even decades. As a novice, you should generally select a trading strategy that entails mid to long trading and investment. This will usually need extra time spent researching and analyzing your transactions before committing. Trading strategy for cryptocurrency. You will need an excellent trading technique to be effective in Bitcoin trading. What exactly is it? A trading strategy is just a plan that you'll use to execute deals. It'll include the type of securities to invest in, the rate of your transactions, and the amount of your investments. In this part, we'll go through the most prevalent cryptocurrency trading techniques. Keep in mind, though, that you may always develop your own particular strategy that works for you. It might be based on one of these basic strategies or on something entirely unique. Why do you need a trading plan? Here are some of the reasons why a cryptocurrency strategy is essential to your success. It's a roadmap. Having and sticking to a trading plan is a lot like having a map. It directs your transactions, advising you on when, where, and why to execute a certain deal. Keeps emotions in check. The interference of sentiments and emotions is one of the most difficult issues that traders face. These become an obstacle when the price of an asset begins to change the direction of a bet. This occurs so regularly with cryptocurrencies that it will develop into an emotional journey. By adhering to their trading strategies, successful traders have learned to maintain deals devoid of emotions. Management of risks. Having a trading strategy effectively pushes people to do the research required to develop it, and part of that study includes the risk element to consider for each trade. The first stage toward risk management is risk identification. Scalping, a trading strategy in which traders profit off small price changes, is a part of day trading but typically involves concise trading periods, think minutes. When either day trading or scalping, many trades will result in both wins and losses. The idea is to make sure that the win-loss ratio is in your favor. Score more wins to consider your strategy a success. Swing trading. When it comes to swing trading, the time period varies. While in day trading and scalping, traders typically open and close positions multiple times within a day. In swing trading, this happens within a much longer period. This could be anything from a few days to a few months. A crypto swing trader will aim to take advantage of an incoming or outgoing trend. In crypto, this strategy is sometimes referred to as BTFD, buy the effin' dip. It means buying when the price is low and selling when the price is high. Extensive application of both FA and TA techniques is necessary when using this strategy. Position trading, HODL. Also called trend trading or following the trend, this strategy involves long-term investing in assets. A trader or investor will typically buy or invest in an asset when the price is low and sell when the price is high, not unlike the other strategies. The only difference is the long time periods between opening and closing a position. This strategy might take many months, if not years, to complete. It is an excellent technique for those who want a hands-off approach. In Bitcoin, this tactic is known as HODL, hold on for dear life. The name comes from a pun on the word hold, which means to purchase and hold. A cryptocurrency trader would buy a token and keep it even if the price was falling. As a result, such a trader is referred to as a hodler. Trading on margin or trading with leverage. Margin trading is a trading tactic rather than a trading strategy. It's a derivative of the regular stock market in which a trader uses borrowed funds to establish positions on a payment system. As expected, the outcomes of margin trading are considerably exaggerated from either side of the trading position. If you win, your trade out is substantially higher, and the opposite is also true. If the deal goes south, you risk a great deal of money. The greater difference there is between the liquidation price and the entrance price, the greater the leverage. Assume you place a transaction with 5x leverage to better comprehend leverage. This indicates that the position size of your transaction is 5 times the amount you pledged from your own wallet. Typically, platforms with leverage trading options provide leverage of 100-fold, which is a risky game and not suitable for novices. Management of risks. It's difficult to discuss Bitcoin trading without including risk management. It's yet another critical component of your success path. In cryptocurrency trading, risk refers to the possibility of an unfavorable event occurring. Trading cryptocurrencies is dangerous, as you may have heard, but so is trading any other financial product, including equities and bonds. What differentiates is the degree of danger. There are several types of hazards, and we'll address those associated with cryptocurrency trading in this section. Market danger. The danger that the market price of a certain asset or the whole crypto market will move abruptly and adversely damage your market position is perhaps the most common. The danger of liquidity. A circumstance in which you will be unable to get out of a position. This usually occurs when you're unable to locate a bidder for your item. Then there are potential legal problems, a circumstance in which a government rule or policy has a detrimental influence on a trading platform. This might cause liquidity issues if purchasers of your cryptocurrency are prevented from acquiring it. Furthermore, if a stock exchange is prohibited in your country, you may lose any cash you have saved with the exchange. Operational danger. This is the chance that a trader faces if he or she is unable to conduct a trading action, such as leaving or starting a position. It might be triggered by a trading platform failure or a trading application problem, for example. The danger is systemic. A loss could be sustained as a result of a breakdown of the overall trading system. Closely connected to market volatility, it is far more serious since it's generated not only by a market downturn, but also by the failure of critical systems inside the marketplace. Consider the financial crisis of 2008. That was a structural failing that resulted in a market crash. Now that you know the types of risks you're likely to face, you consider that each time you make a play. Section 4. How to avoid scams. Crypto is infamous for its scams. As an unregulated and very young asset class, it comes with the territory. Your job is to learn how to read the terrain and navigate this minefield. Here's a rundown of some of the most common crypto scams and how to make sure you never fall victim to them. Fake cryptocurrency. Fake cryptocurrencies are a readily recognizable swindle. These coins are often identified as alternatives to larger cryptocurrencies. A cryptocurrency, for example, could claim to be an impending fork of an existing cryptocurrency like Avalanche, AVAX. Many individuals are unaware of how cryptocurrencies operate. However, they are eager to spend out of fear of losing out, FOMO. Once the perpetrators behind this false cryptocurrency have collected enough money, they move all the funds out of their own checking accounts and rapidly close down the phony enterprise, leaving the investors with no assets. Bitcoin was a painful example that stole $6 million from investors who thought it was a legitimate cryptocurrency. Ponzi schemes. Ponzi schemes are among the world's oldest scams. A Ponzi scam works on the premise that a recruiter recruits two more investors and persuades them to pay him back so that they may double their investment. To do this, the con artist locates four other investors who each contribute the same amount of money, enabling the scammer to make good on his commitment to the first two investors. To give a refund to all four participants, the con artist defrauds another 8 persons, and from there, 16. The inference is that the individual behind the Ponzi scheme does not genuinely invest the money he receives from investors and instead steals it and uses the money of succeeding investors to pay back each round of investors, keeping investigators at bay. Exit scams. The majority of cryptocurrencies collect cash for project development via an initial coin offering, ICO. Based on the group behind the project, ICOs may be private or public. The value of tokens or coins during an ICO is lower than the projected price after they're put into the cryptocurrency world. As a result, investors take advantage of the ICO to purchase a large number of coins while also raising revenue for the business. However, after these ICOs are completed, the project's creators have the option to terminate the project and retain the funds for themselves. This is referred to as an exit scam. Because the basic premise behind cryptocurrencies is privacy, it might be difficult to track down the crooks behind the ICO. As a result, exit scams are among the deadliest online. DeFi scams. Decentralized finance, DeFi, is one of the most important services offered by cryptos such as Dogecoin, which enable these services via the use of smart contracts. Yield farming is a popular use of DeFi. Yield farming, like staking, allows you to lend part of your coins in order to earn additional coins via interest rates. However, since anybody may start their own DeFi project, DeFi frauds can be developed as well. These enticements seem to give you greater rate of interest if you borrow some money, but the individual behind the scheme never returns your cash. This is achievable because of the way the project's smart contracts are written. Bear in mind that this might accidentally happen if a smart contract has faults. Phishing. Phishing is, without a doubt, among the most common online frauds. Phishing is the practice of sending bogus emails to individuals in order to trick them into disclosing private information such as phone numbers, social security numbers, and bank account details. Unfortunately, phishing happens in the cryptocurrency realm as well. For example, persons pretending to be from the firm that makes ledger wallets may send you an email saying that there are difficulties with your assets and that the only way to cure these issues is to provide them with your secret phrase and password. While the majority of individuals do not succumb to these scams, a few do, resulting in considerable financial losses. How to recognize cryptocurrency scams. Let's take a look at several warning signs that point to a crypto fraud. To begin with, if anything seems too good to be true, it generally is. This is common in pump and dump schemes, although it's not confined to them. For example, DeFi projects may provide you with substantially greater yield farming rates than traditional ones, yet astronomically high rates are often a warning indicator, since the project owners might cut and run, and the individuals behind it are merely trying to encourage you to spend more money. Project credibility. There are several factors that contribute to the validity of a project. The first are the company's founders. If the owners are identified, the initiative is less likely to be fraudulent. Of course, Satoshi Nakamoto, the creator of Bitcoin, is an exception, but the great majority of cryptocurrency have a recognized founder or parent organization. The second consideration is if the initiative has a legitimate, secure website and other social media platform. If you answered yes, you should observe how they interact with their community and search for suspicious or odd reactions. Finally, you should check for the project's principal purpose. Typically, new blockchain-based projects aim to provide new or improved services to users. If the initiative has a genuine feasibility, it is less unlikely to be a fraud. The white paper. One of the most significant parts of a cryptocurrency is its white paper. A white paper not only suggests that the project is genuine, but it also helps individuals to grasp how the initiative operates firsthand. When determining the validity of the white paper, consider the project's primary elements, such as the expected total supply, consensus methods, algorithms, or other components to determine if the project can really work as claimed. It should be noted that a white paper does not always indicate that a cryptocurrency is legitimate. Scammers may create a simple, professional-looking, and entirely fraudulent white paper in order to steal your money. Being asked to send money. It should go without saying that an anonymous stranger asking you for money is more than a little suspicious. Legitimate crypto founders never directly solicit funds from anybody. Fraudsters, on the other hand, are excellent in immediately intimidating you into handing over access to your wallet. There are several online crypto frauds. They're becoming a growing issue for those looking to invest in cryptocurrencies responsibly. Most of these scams, however, may be avoided if you're cautious and learn to recognize signals that indicate a fraud. As a result, bear in mind that you may be exposed to cryptocurrency scams and follow the precautions outlined in this article to prevent falling victim to them. Section 5. How to do your own research. If you've spent much time reading crypto material, you've most certainly seen the do your own research, or DYOR mantra. However, few seem to explain or demonstrate how to conduct your own research on Bitcoin investments. The classic adage, knowledge is power, is particularly true for cryptocurrency investors. As a result, studying a concept before investing is critical. I've created a step-by-step DYOR tutorial that I utilize before each new crypto investment. Key guidelines. You should not trust everything you read. Never invest until you fully understand what you're getting into. Stick to reliable sources and seek as many diverse perspectives as possible. Learning to DYOR and analyze a project is the most effective technique to achieve lasting success in crypto. DYOR is a constant process that you will improve at over time. 1. Gathering of information. When you learn about a new or fascinating crypto project, don't immediately place a purchase order. Take the time to investigate what they promise to give. What exactly does this mean? Here's a reliable approach. First, we look to see whether the project is listed on CoinMarketCap. If it isn't on the list, skip it and go on. If the coin is mentioned, then visit their website. Typically, your first impression of a website will serve as your bullshit detector. Do they, for example, have a site that seems to have been thrown up in a hurry? Is their organization fully anonymous, or is it made up of simply one individual with a variety of haircuts? Do they make up phrases like creating the Internet of blockchains or tokenizing Web 4.0? Noticing such aspects on a first encounter is a dead giveaway that you're dealing with a fraudster. If your BS detector hasn't gone off at this stage, it suggests the coin is worth investigating further. Go through their team members' LinkedIn profiles, the project roadmap. This has been the ultimate guide to investing in cryptocurrency. How to make money on blockchain, DeFi, Bitcoin, altcoins, NFTs, and the next big thing, the Metaverse. Written by Christie Brothers, narrated by Russell Newton. Copyright 2022 by Christie Brothers. Production copyright by Christie Brothers.